Building wealth and getting rich is really easy. It's so easy, in fact, that anybody can do it, no matter what your age, job, or background. In this video, I'm going to show you exactly how you can build your wealth and get rich. The key to growing your wealth and achieving the financial freedom that so many of us are striving for is to not try and get rich overnight, but to play the long game. Growing your wealth is a marathon, not a sprint. Sadly, in the world that we now live in, people want instant gratification. They want fast food, they want next day shipping, and they want high-speed internet so that they can binge watch an entire season of their favourite show in one day, rather than waiting a week for the next episode. Many people these days want everything fast, and that includes growing their wealth, financial freedom, and retirement. And because they want it fast, they may take risks and make bad decisions when it comes to investing, and that is going to lose them money. People need to get out of that get rich quick mentality and start thinking long term. History has shown us that by investing regularly and consistently into the stock market can and will make you very wealthy over time. Now obviously you need to be investing into the right stocks, index funds or mutual funds, but if you do, you will most certainly get rich and earn that financial freedom that you desire. In a moment, we'll take a look at a couple of examples of how much you could earn if you invested every single month into an index fund from now until retirement. But before we get into the calculations, let me just explain what an index fund actually is for those of you that don't know. An index fund is an investment fund that tracks a specific collection of assets called an index. The index can include stocks, bonds, and other assets, including commodities such as gold. Now, when you invest into an index fund, you're effectively investing into all of the companies contained within the fund. So rather than buying individual stocks such as Apple, Amazon, and Tesla, you can invest into the S&P 500 index fund and own part shares in all these companies, as well as hundreds more. Now, the beauty of investing into an index fund is that if one or more of the companies in the fund are not performing so well in the market, you still have lots of other companies to offset any losses. Some of the most popular index funds are the S&P 500, which tracks around 500 of the largest companies in the US, the Dow Jones Industrial Average, which tracks 30 of the largest companies in the US, the Nasdaq Composite, which measures the performance of more than 3,000 companies listed on the Nasdaq stock market and is known for its heavy exposure into the technology sector, and the FTSE 100, which tracks the 100 largest companies traded on the London Stock Exchange. But there are so many more index funds, mutual funds and ETFs that you can invest into. In the following examples, we're going to be using an interest rate of 10% annually, which is often quoted as being the average stock market return. If we were to use the average that the S&P 500 has returned over the last 10 years, we could be seeing approximately 15% returns. But for these examples, we'll stick to a 10% average. So I'm just going to run through a couple of examples here using this compound interest calculator. Now I'm using this website investor.gov. This is a US website, but there are plenty of websites out there for GBP or euros or wherever you are. I mean, you can use this calculator anyway. It doesn't matter what currency you're using, the numbers are going to work out the same at the end of the calculation. But I'm just using this one because it is a very good calculator, easy to use, and it's got good functionality. So we're going to give a couple of examples. The first one's going to be, I'm assuming you're 18 years old, you're going to invest for 32 years, so until you're 50, and we're going to invest $100 a month and see what kind of returns we can expect. So we'll put $100 in as our initial investment, we'll put $100 in as our monthly contribution, we'll put 32 years as our length in years, we'll put an estimated interest rate of 10%, and we'll put an interest rate variance of 2%, so that means we'll get calculations for 8%, 10% and 12%, so that's 2% either side of the 10%. We're going to have a compound frequency of annually, and we're going to click calculate. So if we look at the figures here, after 32 years, we're going to have $243,476.70 after investing $100 a month for those 32 years. Now, if the interest rate is 12%, which it possibly could be, then the return will be $369,575.44. On the other hand, if the interest rate is 8%, then the return is going to be $162,229.95. And like I say, you can obviously use these figures in pounds, euros, Singaporean dollars, whatever nationality you are or whatever country you're investing in, these figures will be the same. Now, if we were to take that length of time in years up to 40 years and click calculate, we can see that the power of compound interest has put our return up to $535,636.99. So for just 8 years more, we're getting so much more back in return. So you can see how compound interest is really working over that length of time. The longer you invest, the higher the compound interest will be and the more you'll get in return. So that's all well and good if we're 18 years old or if we've got 32 years ahead of us to invest, but what if we're more mature? Say we're 55 years of age and we want to retire when we're 70. What kind of returns can we expect then? So using the same investment of $100 a month for 15 years, we're going to use the same interest rate and we've got a variance range of 2% and we're going to compound annually. Let's click calculate and we can see that after 15 years we'd have $38,544.70. That's with an interest rate of 10%. If we got that 12% interest, then we'd have $45,283, and if we had the 8%, then we'd only have $32,899. I say only, it's still quite a considerable sum considering you've only been investing for 15 years and you've only been putting away $100 a month. Now if you are 55 and you've got a good job and you've got things in order, you've maybe paid off your mortgage, you've probably got much more than $100 a month to start investing. So let's bump these figures up a little bit. We'll put in $300 here and see what kind of calculation we get after 15 years. So we'll click calculate and we can see that we're going to have $115,634.11 after just 15 years. If the percentage rate was 12%, then that would be $135,000, and if it was 8%, it would be $98,000. Now these calculations are using that average of 10%, which the stock market tends to give, but if you were to invest into, say, the S&P 500, which is on average giving 13 to 15% each year for the last 10 years, then we can see that we'll get much higher returns. So again, using this $300 per month, 15 years, we're going to bump that interest up to 15%. Click calculate. We can see that in 15 years we'd have $173,000. If we got the maximum there of 17%, which is 2% above that average, then we'd have $205,000. And if we had 2% below, then we'd be on $147,000. Now, just one last calculation. If you are 18 years old and you start investing $100 a month for the next 32 years, and you're going to get that 15% average from the S&P 500, then you will see that the power of compound interest will give you $701,000 in return after just 32 years of investing. So when you're 50 years old, you will have $701,000 in the bank. If you get that 17%, and I'm sure the interest rates will increase over that duration between now and 32 years from now, then you could expect to have over $1 million in the bank. So you can truly see the power of compound interest, and that's just investing $100 each and every month for the next 32 years. And that's if you're only investing $100 from being 18 years of age. Obviously, as your career grows, your skills grow, you start earning more money, you can start putting in more than $100 every month. So these figures are just going to be astronomical. So you can really see the power of compound interest and why it's so important to start investing as early as you possibly can. Now, obviously, the earlier that you start investing, the more money you will have when it comes to retiring. Alternatively, you could potentially retire much sooner if you start investing as soon as you're able to. Now, at this point, I just want to make you aware that there are some YouTubers and influencers out there who put out similar content to this. And even though the information is valid and valuable, they claim to be millionaires, and they're not all millionaires. Take it from me, just a little bit of background research and investigation will prove that they're not millionaires. So just be wary that what some people are telling you isn't always 100% truthful. Now, I'm what you might call a late starter myself, and I didn't really start looking into investing into the stock market until I was in my 40s. I still have a lot of catching up to do now, which means I need to invest much more money each month than if I'd started investing in my teens or in my 20s. Now I just try to invest every spare bit of cash that I have, no matter how little. I just keep adding each month and let the power of compound interest do its thing. Now, I'm not a millionaire, unfortunately, and I won't claim to be a millionaire, and at my current age and starting my investment journey so late, I'm unlikely to become a millionaire, well, from my investments anyway, not unless I have a really big windfall or suddenly start earning ridiculous amounts of money each month. Even so, I'll still be in a much better place when it comes to retiring than if I wasn't investing. You, on the other hand, especially you guys between 18 and 25 years of age, can become a millionaire if you start investing right now. Even as little as $100 a month for the next 32 years will give you over $243,000. Do that for 40 years and you'd have over $535,000. That means that if you start investing $100 at age 18, by the time you're 58, you'd have over $500,000. If you're in your 40s or 50s, then you won't have as much, but that's not to say it's not worth doing. $100 per month for somebody who's 55 will still return over $38,000. Bump that up to $300 per month and you'd be sitting on $115,000 by the time you're 70. The bottom line is that no matter what your age, you should start investing right now. Don't wait a moment longer. The longer you wait, the less you'll have when it comes time for you to withdraw your funds. I know many of you younger people will not buy into this idea of starting saving and investing so early, but those of you that do will not regret it when you're older. Now, when I was young, so many years ago, I remember all too well rolling my eyes at advice offered by my mum and other adults and thinking, what do they know? They're just old people, or what you youngsters might call boomers these days. I've lost count of the amount of times I've been referred to as a boomer. But take it from somebody who's been there and who left it late in life to start getting my finances in order. If you listen to what older people are telling you and take their advice, you will not regret it. They've got the knowledge and life experiences, good and bad, that will help you succeed in life. Now, before investing, you should always be in a strong financial position to start with. That means being debt-free and having a regular source of income. If you have debt, then paying this off should be your #1 priority. If you are debt-free and have some disposable income and want to get rich, retire early and live your best life, then start investing into the stock market right now. This will be one of the best decisions you'll ever make. Now, if you have any questions, comments or feedback, then please leave them down below, or why not come and join me on Discord and talk with myself and other like-minded people. I'll leave a link to my Discord server down below, and also I'll leave a link to my Twitter page. Also, very soon you'll be able to find me on the brand new community-driven investing platform shares.io. Now, this platform is great for younger investors just starting out. The communities area of shares.io is full of helpful advice and support from ambassadors like myself and other investors like you. So that's it for this video, guys. I hope you found it useful. If you did, then please leave me a big thumbs up down below, as it will help get this video out to more people who'd like to see it. Also, don't forget to subscribe and hit the notification bell for more content like this. Take care, and as always, stay safe and trust no one.